Hey traders, this here is a mini lesson about diagonals or calendars. Those are important around earnings. This happened today during the live room session. We had over 300 members at the time trading live with me, sharing my screen, so I took the opportunity to discuss a trade setup for Fedex specifically, but this is not about that trade. It's about using it as an example to teach a lesson for next time. First lesson is we knew that Fedex was reporting after the bell, and if somebody wanted to play calls or puts, I suggested they use something other than current week because the implied volatility was super high. Simply said, the calls or puts are super expensive relative to normal prices, and tomorrow morning they won't be. So if you buy them today for this week, you're overpaying, and that extra premium disappears regardless of which way it moves in the morning. So it was best to buy 2 weeks out. So January 6th, for example, that would have been what I wanted to buy. So normally somebody buys a call or a put, whichever way you guess. I guessed up based on the data in the calls and the puts in the options chain. So I chose calls, and it would have been $480 to buy the call I wanted. Now, I could have turned it into a spread by selling a call above it. That would have been a vertical spread. So how do you turn a spread from being a vertical spread into a calendar spread? You simply, instead of selling it in the same time frame, you sell it out here. So you buy the 170, you sell the 170, and that would be a calendar spread. Now, this one would be difficult to manage tomorrow. Why? Because price is already at it. So you will have profits right away, and if you don't book them, they turn into losses because you're long and short at the same place, and you paid to be there. Not a good position to be in. So I said you can change that into a diagonal by moving it up. And if you do, instead of selling this, you're selling it higher, which is what I chose to do. So tomorrow, this one is going to be very profitable. This one is going to be profitable, maybe. Why do I say maybe? Because I oversold it. Those who bought this from me paid the premium that's going to disappear in the morning. So this one is going to lose a lot because of that fact. This one isn't. I paid going rate for this one because it's out in time. The implied volatility was about half this one. So even if this stock did not rally, as long as it doesn't collapse, this trade would have yielded a profit because this one would have lost, this one I sold for the week, would have lost a lot faster than this one that I bought out in time. So if the market opens here tomorrow, I will have nice healthy profit. So if I did this as a trade, I would book it in the morning at the open. If I didn't, I did this to go long Fedex, which I didn't. I don't know much about Fedex here. I just took the trade based on the data in the options table, to be honest. But if indeed it's in the support zone, I may want to trade it so that this one dies from maximum gains on Friday. So I'm left long this for a discount. Remember, I only paid $475, but I didn't because I collected $260. So I only paid, I think it was $180. The difference between these two, it's a long day. You do the math. And it's going to be worth then $500 tomorrow, most likely. And I only paid half. So it's going to be a good setup with a lot. Now, assuming we open here. Now, anything can happen. They can open down here, in which case I still think it would yield profits. So this is a difference between a vertical spread, a calendar spread, and a diagonal spread. Okay, you can't do both of these together. And you have to always remember to buy the one out in time. Your platform will probably remind you if you try to flip-flop the number signs. And these were the two trade setups that I shared, how to do these. Anyway, quick video, reminder, lesson, whatever you want to call it, on calendars, diagonals, and how they are different than the verticals.